Hey there, Prof. Aram here, and in this video we're going to go over the concept of common stocks and how are they different from bonds that we've already covered. So let's get to this. We already know that one of the main sources of capital that companies use to pay for these cash flow generating assets is debt. The other important source of capital is equity, mostly common equity. Companies usually have two sources of equity when they are young. One of the ways for them to finance their growth is to sell part of the firm to private equity or venture capital firms. But at some point, the growth is so fast that these providers of the capital are not willing to put up more capital. So firms decide to go public, meaning that they want to sell common stocks to public investors, to individual investors, and institutional investors. So our goal in this series of videos is to focus on this common stock component of the capital structure and find out what is the value of the common stock. And the value that we are looking at is the market value, because book value is already stated under the shareholders' equity. What we are looking for is the market value. Let's first look at some of the similarities between bonds and stocks. Both of these two sources of capital provide long-term financing for the firm. And then both are future funds that an investor must consider. And both have future periodic payments. Bonds pay coupons and stocks hopefully pay dividends. Not all of them, but some stocks pay dividends. But there is an expectation that at some point in the future, all the stocks pay dividends. And both of them can be purchased at a price today. Whatever the market price is today, you can buy bonds or stocks of a particular firm. What are the differences? A common stock is way harder to value than a bond for mainly three reasons. For a common stock, the promised cash flows are not known in advance. Meaning that, for example, when you buy a bond, you know exactly how many coupons you will receive, and you know exactly how much face value you will receive at maturity. So the cash flows are determined before you purchase the bond. But for a stock, you never know what are the exact cash flows that you will receive from that stock in the future. Dividends may change. Dividends may increase, or some companies which are in trouble can cut their dividends or omit the dividends altogether. There is no promised cash flow when you buy a common stock. And then the life of the investment is essentially forever because they have no maturity. So when you buy a stock, we are assuming that as long as the company exists, that stock also exists. But when you buy a bond, there's an end date to the cash flows of that bond. There's a maturity date for the bond. So this perpetuity characteristic of a stock makes it a little bit harder than a bond to value. And of course, there is no way to easily observe the rate of return that the market requires. So when you look at a bond, you know what are the cash flows of the bonds are, and you can observe the price of the bond today in the market. So with the information regarding the price today and the cash flows and the maturity, you can exactly find out what is the rate of return for that bond. But that's not necessarily true for the stock. You can't really observe the true rate of return for a stock, for a common stock. You can estimate it using the historical information, but you can't give me the exact rate of return for a stock. Also, from the firm's perspective, bond is considered long-term debt, a stock is considered equity. Again, from the firm's perspective, the bond is paid off at maturity, whereas the stock continues indefinitely. And bonds payment, we already know, are the coupons and a lump sum, but the stock that pays dividend is assumed to pay dividend forever, or as long as the company exists. And the coupon payments are fixed, but the dividends can change or grow over time. So these are all the things that make valuation of the stocks a little bit more challenging. So in terms of the timeline, when you want to visualize the differences between bonds and the stocks, you see that a bond will pay the same coupon every period, whereas dividends are not necessarily the same every period. Another difference is that for a bond, you will receive a lump sum at maturity date of the bond, but no such thing happens here. There is no promised cash flow from a stock. Okay. Another major difference is this. There is a maturity date, in this case year 4, for a bond, but there is no stated maturity date for a stock. So I hope you find these useful, and thanks for watching.